Many investors feel a palpable sense of dread whenever they hear the term bear market. Because of this, it is inevitable that there will be periods of substantial market declines, although these periods are usually brief in comparison with those of bull markets when the market values rise. Even in a down market, there are still solid investment opportunities to be discovered. However, a bull market may last for a long time, but it can't last for infinity. Moreover, it is best to be prepared rather than astonished when a bull market comes to a halt. So, how do you prepare for this? Bear markets are characterized by a long-term decline in investment prices. Typically, a bear market occurs when the broad market index drops by 20% or more from its previous peak. This means that a market as a whole might experience a bear market while individual equities may also be affected. For an example, on June 13, 2022, the S&P 500 fell into the negative area. It's down by almost 21% year-to-date. Therefore, bear markets are distinguished by the pessimism and lack of confidence shown by market participants. And during a bear market, investors tend to disregard any positive news and continue selling, resulting in a steeper decline in prices. Even if investors are pessimistic about the individual stock, such an attitude may not have an impact on the market as a whole. Although individual firms may be reporting positive news and expanding profits, when market sentiment goes pessimistic, practically all stocks within the market begin to decrease. However, let's get into the 7 strategies to consider when investing in a bearish market. Number 1. Use dollar cost averaging to your advantage. Suppose a stock in your portfolio drops from $100 a share to $75 a share in a quarter of a percentage point. If you have money to invest and you want to purchase more of this company, it might be tempting to attempt to buy when you think the price of the stock has cratered, especially if you believe that the price of the stock will continue to fall. But you will likely be incorrect. In fact, that stock could fall by up to 50% or more from its recent high. This is why attempting to time the market or pinpoint the bottom is a dangerous endeavor. Furthermore, the idea of dollar cost averaging is a more conservative method for investing in the stock market. As the name suggests, dollar cost averaging refers to the practice of making regular, about equal-sized investments over time. This ensures that you don't put all of your money into a stock at the peak of its value, while still taking advantage of market dips. There's no denying that bear markets may be frightening, but the stock market has shown that it will recover. In a bear market, when stock prices go down, you can take advantage of this by shifting your focus from possible losses to possible gains. Number 2. Invest in industries that do well during recessions. During a market crisis, industries that have a history of strong performance are good places to look for stabilizing assets. Things like consumer staples and utilities usually do better in bear markets than others. You can invest in certain industries by using index funds or exchange-traded funds that mirror a market standard. For example, buying into a consumer staples ETF will expose you to firms in this category, which tends to be more recession-resistant. And it's better to invest in an index fund or ETF than a single stock, because each fund includes shares in several firms. Number 3. Focus on the long term. Bear markets put every investor to the test. While these times are tough to bear, history indicates that the market will likely rebound quickly. And if you are investing for a long-term purpose, such as retirement, bear markets will be eclipsed by bull markets. The stock market should not be used to invest funds for short-term goals, which are often accomplished in less than 5 years. In spite of this, it's a good idea to avoid the desire to sell stocks when the market declines. If you find it difficult to stay away from your assets during a bear market, a robo-advisor or financial advisor may take care of them for you in both good and bad times. Number 4. Keep your portfolio diversified. Let's imagine that your portfolio is in a slump. Is there a way to get it back on track? Being well diversified may help protect against losses. Every bear market has a few sectors that take the brunt of the fall more than others. Because it's impossible to predict these events in advance, you should diversify your portfolio across several asset classes and the stock market. Think about the assets you've put up for medium-term requirements or aspirations, and having a broad range of investment-grade bonds, such as corporate, municipal, treasuries, and potentially overseas issuance, is a sign of diversification, as well as having bonds with different maturity dates, from short to medium term. They should always have some bonds coming due and making money or money to reinvest. However, as a long-term investor, according to Mark, a financial analyst, your long-term assets should be spread among a diverse range of domestic equities, big and small, fast-growing and dividend-paying, as well as foreign companies, real estate investment trusts, REITs, and commodities. He goes on to say that this mix gives you access to different types of assets that move at different rates and over different time periods. Number 5. Put money in your kit. Cash is one of the lowest returning asset types, but this should not blind you to its diversification potential over the long run. Because cash's connection to other asset types is so low, it may act as a hedge against price fluctuations. Additionally, cash reserves might come in handy when the market is in decline. However, when prices are low, you may buy in with cash rather than having to sell shares at a loss if those securities are likewise at a low point. As a result, cash can give both stability and flexibility to your portfolio. 6. Identify strategic opportunities. During a market downturn, defensive equities such as consumer staples, healthcare, and utilities, as well as firms with higher quality operations and balance sheets, may provide possibilities. Also, high-quality dividend-paying stocks, especially those whose dividends have been steadily raised over time, may help your overall return when stock prices are low. It's also a good idea to look into a professionally managed fiduciary account, which is monitored by a third party for the benefit of the account owner and is rebalanced as necessary. Several mutual funds employ investment teams. This is in contrast to passive investing, in which a set of equities is linked to a certain index and has outperformed the market as a whole. When markets are difficult, professionally managed funds may outperform passively managed funds. Number 7. Spread out your investments. If you're looking to buy stocks at a discount, increasing your portfolio's diversity by including a variety of different assets is another smart move, down market or not. During a bear market, the stock prices of every company in a certain index, such as the S&P 500, decline, although not always by the same amount. That is why flexibility is so important. And when you have a mix of successes and losers in your portfolio, your total losses are reduced. If only you could foresee who would prevail and who would fall short. Because economic recessions generally precede or coincide with bear markets, investors tend to select assets that provide a stable return regardless of the state of the economy. Add the following assets to your portfolio as a part of a protective strategy. First is stocks that pay dividends. Dividends are still a popular type of compensation for many investors, even if stock prices aren't moving in the right direction. For this reason, in down markets, investors will be drawn to firms that pay out bigger dividends than the industry average. Second is bonds. Bonds are also a good investment during volatile times in the stock market, since their prices tend to fluctuate in the opposite direction of stock prices and are considered an important part of any portfolio. But adding more high-quality, short-term bonds to your portfolio may help alleviate the agony of a down market. However, bear markets are not the time to worry, but rather a good moment to ensure that your portfolio is adequately diversified and de-risked. Before making a decision, get a clear picture of your financial and time constraints. Also, a bear market might be frightening, but putting your money at risk because of your anxiety is a foolish move. If you want to win, you need a plan. You don't just jump to conclusions without doing any research or planning ahead of time. And with that, this video comes to an end. See you in the next one.